Before we get into the Exxon versus Chevron debate, there's probably a bigger question to answer here, which is why invest in oil in the first place? Well, this chart was actually taken from Exxon, but I think it's a fair depiction of the world's energy mix, both today and through 2050. So you see the yellow band there that represents wind and solar, solar being the dominant of the two, and that's why we have exposure to solar. And you look at the top there, other renewables. You may wonder what that is. Well, it encompasses biomass, biofuels, and geothermal. And you say, well, those don't make up. And then you look, well, it includes hydropower. Okay, now you understand why that's a big chunk there. And you have nuclear, natural gas, and oil. And looking at the green bar across the top there, you see the dip, the Rona dip there in 2020. And then you see the green bar is sort of just gliding along, slowly moving downwards. So the demand for oil is going to remain relatively the same. And why is that? Because oil isn't just what you put into your car every 4 or 5 years. It's what Americans consume an awful lot of. America consumes 20 million barrels of oil per day. And you can see this picture here. The typical products made from 1 barrel of refined crude oil, and you have asphalt there at the top, so I don't know too many replacements there for asphalt that are in the works, but then you have liquefied petroleum, jet fuel, which is only 10%, 18% other products. So look on the right-hand side here at the list of products that come from a barrel of oil, and you see these protesters all the time waving their placards, and maybe they ought to not wear clothes or perfume or makeup or lipstick or nail polish or sweaters or those phones that they use to organize themselves. Pretty much everything that goes into a protest and a protester comes from a barrel of oil. So we need to figure out replacements for these things, right? So that's what you need to do is put down the placard, go and start studying a STEM degree, and then go join a company like maybe join Ginkgo Bioworks, where they're trying to figure out how to harness the power of nature to replace some of these things. There's other interesting companies out there working on this stuff as well. When you see diesel fuel and heating oil, you go around the world and see just how reliable people in emerging markets are on diesel and heating oil. And you have gasoline that powers our car engines and goes into our tanks. So a barrel of oil goes into a lot of different things, and the price of crude oil over the years has changed dramatically. So you can see around 2005 that initial spike above $50 a barrel. That's when I started to research peak oil quite heavily. The idea there is that people were saying there's no more oil. Well, that's not true. There's a ton of oil. It's just becoming harder to get, right? So as the price of oil goes up, then more methods to extract become economically viable, such as Canadian oil sands. I used to think those were my ticket to wealth. I remember pitching this to an investment banker in an interview once when I was trying to get into finance. And at that time, the price of oil was going very high. You could see it actually hit a real spike there, $130 a barrel at one point before it went plunging back down. But I learned that all methods of extracting, of course, aren't equal, and that when you start pushing the price of oil very high, then people find substitutes. Now, investing in commodity producers can be very volatile. Ask anybody that invests in miners, right? And these operations typically require a lot of hedging, but not too much because you want some exposure to that upside, so it becomes quite tricky. Oil's a commodity, and it behaves fairly unpredictably. For example, who would have predicted negatively priced oil during the Rona? So, per Reuters, on Monday, April 21st in 2020, the price of U.S. oil turned negative for the first time in history, forcing producers to pay buyers to take the barrels that they could not store due to the oversupply of oil. That's crazy, getting paid to take oil. And that didn't last very long, and you can see the chart here where we're at now. So there are a lot of arguments against investing in oil. Oil's going away, as I mentioned before. Well, it's probably going nowhere fast. It's becoming tougher to get, so margins are declining. fair enough, but those just become pass-through costs. The question is, does that eventually affect demand? The big bad oil companies are evil. Well, if you believe the ESG people, we sure don't, then this isn't an issue, because I think most of the ESG folks out there rate Exxon higher than Tesla in terms of how good it is. If the price of oil falls dramatically, oil companies are screwed. Not necessarily, and there's a number of reasons for that. First of all, hedging helps minimize the impact of price shocks, but the upstream and downstream business models these oil majors employ, they're very clever. We'll talk about that in a second. But what ESG people don't realize about investing in oil is that passive investors are going to invest regardless. So I remember MSCI getting a lot of flack saying, well, you're a leading provider of ESG. How dare you invest in oil? And Henry was trying to explain to everybody, look, that's just the nature of the business, man. It's one of 11 industries you can see here. And you see energy 3 down there, and I highlighted 2 spots where it's most correlated to other sectors. What are they? Industrials and materials. That makes sense. That's intuitive, right? And then you can see it's not so correlated to other sectors such as healthcare and consumer staples. So if you're a portfolio manager, then you want to have representation, generally speaking, across all sectors. And in this case, when we talk about the energy sector, that comprises companies engaged in exploration and production, refining, marketing, etc., of oil and gas and coal and consumable fuels. All right. So an example of a renewable energy company, the biggest in the world, NextEra Energy, they're actually in utilities. So what you'd want to do to better understand this sector is get the GIC sector breakdown and look at that. But we can just go right to the juicy stuff and look at the biggest oil and gas companies in the world. Here they are on the left-hand side, portrayed in terms of revenue. So you have the Saudis there at the top. That's no surprise. Then 2 big Chinese petroleum companies there, PetroChina, Sinopec. Then you have Exxon, Shell, Total, BP, and Chevron at the bottom there. But then when you look at market cap on the right here, you see Saudis at the top, and then Exxon and Chevron. Exxon's $479 billion market cap. Chevron at $300 billion. And when we look at our dividend growth strategy, Quantigence, so we've ranked over 80 dividend champions, companies that we find to be the most exceptional opportunities for dividend growth investors. In the top 10 list, look, there's Chevron and Exxon. Interesting. Both companies are very compelling. And then when we look at them side by side there along the bottom, both share pretty similar attributes. These are companies that appear very similarly. We see, though, that Exxon isn't growing the dividend as fast, and we'll look at that. Now, when you look at their revenues, of course, the blue line at the top is Exxon. They have more revenues, right, as you would expect. They are pretty correlated. So these companies, if you had them as your only constituents of a portfolio, they wouldn't provide you with much diversification, right? They behave very similarly, but the key difference between these 2 companies is how they make money. So let's talk about the basic business model of an oil major. So you have what's called upstream. That's exploration and extraction, right? Pretty basic stuff. And you have downstream. That's refining the crude and turning it into products. When we look at Exxon, they have 3 main segments. Upstream's called upstream, and they have downstream called product solutions, and that's composed of 3 segments: energy products, chemical products, specialty products. Then they have this other segment called low carbon solutions. That's a cost center included in corporate and financing. These 3 businesses are supported by these, service delivery groups. But what this business model allows for is a natural hedge. The upstream benefits from higher oil prices. So when you extract a commodity, you're going to make more when prices are higher. Downstream benefits from lower oil prices. So when you use a commodity as a key input, the cheaper it is, the better. So that provides a natural hedge there. And when the price of oil goes way down, then the downstream is going to do better. It helped offset the losses on the upstream. And the Rona was an exception. I think with the case of Exxon, they had one of their subsegments actually showing a profit. The rest were all running losses, and Chevron was as well during 2020. So when we look at upstream earnings for Exxon. This is very interesting. So you see 2021 earnings on the left. That was $15.7 billion. Then we can go along here and move to the right and see how that number changed going into 2022. And you see price, huge jump, right? Volume mix, slight dip, other slight dip. Russia, there's a bit of a ding, right? Minus $2.4 billion. Then you get to 2022 earnings. If you back out the price change, so in other words, with the price of oil fixed and that Russia one-time event removed, their upstream only fell 6% in 2022. Well, what actually happened? Well, it was up 130% in 2022, the earnings. That's crazy. That's huge. Why? Because of the volatility of the commodity that they're extracting. So they're highly dependent on the price of oil. This chart shows you that. See, in 2022 to 2023, how oil was running up there compared to the previous year. And then look at the next year, 2023 to 2024. So we see that the price of oil is settling down, and we would expect then to see their earnings fall. Indeed, and look at the dramatic fall here. So going from $36.4 billion there, the price, and then you have the other factors get down to $21.308, so $21 billion. With the price of oil fixed, their upstream only grew 4% that year. But then that's with the price fixed. With the price out not fixed, what actually happened is that it's down 42%. So you can see here just how much the price of oil actually affects their upstream segment. Now, pay attention to this $21.3 billion number there on the right. And then we move to the next slide, and there it is, upstream, $21.3 billion. Then let's add downstream. Remember we talked about the three downstream subsegments for Exxon: energy products, chemical products, specialty products. Then you have corporate and financing, a little negative there. Totals $36 billion. Well, that also happens to be the number. If you go to Yahoo Finance and pull up Exxon's financials, basics, see revenue for 2023 there. That's a lot, right? Coming up on $350 billion. They don't focus hardly at all on revenue, because earnings are so important to the company. And you see that earnings of $36 billion. But then look to the left for 2020. Here are the numbers that they had for the Rona. So upstream, they lost $20 billion. Downstream lost $1.1 billion. They were named differently back then. Chemicals, they made $2 billion in positive earnings. But it was a total wash that year. And these oil companies are structured very well. So Exxon's been not only paying but increasing a dividend for over 40 years, and they're able to weather turmoil very well. I can recall during the Rona getting very concerned. We actually bought more Exxon at that time because we knew the price of oil wasn't going to stay negative forever. It was a one-off. But I remember looking at Chevron's deck, and the first slide for investors said, "We're going to keep increasing our dividend," or something. I'm paraphrasing. The dividend was a focal point. That's what you want to see, right? That gives you the confidence that these companies are going to keep increasing their dividends over time. Now, asking the question, what's the difference between Chevron and Exxon? I think it all comes down to this. Now that we understand upstream versus downstream, the mix on the left, you see Chevron's upstream in 2023, it appears to be about 78% upstream and 22% downstream, right? So it appears their downstream is slowly increasing over time, though that's not the intent of the company. They have said that they want to increase upstream as a priority. Then look to the right there at Exxon, much more balanced, you see. So in 2023, you have downstream is 40-some%. It looks like 42% or so. So from that perspective, I think as risk-averse investors, we don't really want to take a gamble either way. We like a good mix, a good balance. Going back to that comment about having a natural hedge between the upstream and the downstream. Now, when you look at dividend information, just some basics I took from Schwab here, Exxon's payout ratio is lower, not by a lot. It's 41% compared to Chevron at 53%, but that gives them a little more leeway to increase the dividend. They haven't been growing it very well so far. You can see 10-year growth rate for Exxon, 4.1%, for Chevron, 4.5%. In the last 5 years, we actually penalize Exxon for having 2.6% whereas Chevron doesn't because they have 6.2%. That's much better growth. Chevron also offers a better yield right now at 4% versus Exxon at 3.14%. The other thing to note about these companies is that they're always looking at growing not only organically but by acquisition. And late last year, they made some very large deals. So Exxon significantly expanded their Permian Basin holdings when they paid $60 billion for Pioneer Natural Resources. And both these acquisitions were without taking on debt. Permian Basin, by the way, that's in Texas, so it's U.S. resources. And then Chevron followed up with their $53 billion purchase of Hess. It says bolstering its shares of an Exxon-led project offshore from, and I put question marks here because I want to ask you a question. What country of 791,000 people is poised to become the world's fourth largest offshore oil producer, placing it ahead of Qatar, the United States, Mexico, and Norway? So 791,000 people, it's about the size of Seattle. The answer is Guyana. So that's the only mainland South American nation in which English is the official language. However, most of them speak Guyanese Creole. So that's certainly a place to go before things start getting very expensive. So just some concluding thoughts. Chevron and Exxon are so much alike, you could just flip a coin pretty much. Chevron does provide more upstream exposure, but we prefer Exxon's more diversified portfolio. Of course, Chevron has a better yield currently, but these are very complex companies, lots of data to analyze, so it's always best to have a simple metric to guide yourself. Ours is this: dividend increase. If these companies keep increasing their dividends, and we're invested in both, we stay invested. It's as simple as that. So I'm going to go ahead and leave you with another video here on electric dividend stocks. This is quite interesting considering the growth of AI and the impact that might have on electricity. So give that a watch. Please make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.